Welcome to today's deep dive. We are jumping right into a really fascinating piece of financial research today, specifically a Bank of America Global Research Report.
Yeah, from May 4th, 2026.
Right. And our mission for you today is simple. We're looking at MediaTek. We want to understand how a company that's basically known for, you know, powering consumer smartphones is suddenly this heavy hitter in the global AI infrastructure race.
It is a massive pivot, truly.
It really is. Okay, let's unpack this. We're going to start with BOFO's core conclusion, hit the data, look at the big driver, the risks, and finally, their investment advice.
Sounds good. So jumping into that core conclusion, Bank of America is reiterating a BUY rating on MediaTek.
But it's not just a standard buy rating, right?
Oh, no, not at all. They aggressively raised their price objective. It went from 2,160 TWD all the way up to a massive 3,000 TWD.
Wow. Yeah, so it's like, I was thinking about that, it's like having this reliable everyday commuter car, right? And you pop the hood and suddenly there's just a hyper-advanced jet engine in there.
Yeah. That's actually a great analogy. The market is finally pricing in the jet engine.
Right.
And that jet engine is a massive pivot toward custom AI chips or ASICs and tensor processing units, TPUs.
Okay, but before we get to that shiny AI future, we have to look at the bedrock data from Q1 2026. Like, why is BOFA so confident?
Yeah, the data is really telling here.
So data point one, the resilience. Q1 2026 sales only dipped by like 1% quarter over quarter.
Which is wild.
It is. Wait, the report says their core smartphone chip shipments dropped by a painful 17%? How did they survive that? I mean, structurally, how?
Well, you have to look at the other divisions. Their smart edge platforms jumped 23%.
Oh, wow.
Yeah, and their power ICs rose 14%. So they had this better product mix, and that actually pushed gross margins up to 46.3%.
Okay, so selling less volume but making way more money per chip.
Exactly. Operating margins hit 15.3%. They essentially replaced that low-margin smartphone volume with high-margin specialized stuff.
Which brings us to data point two, beating the street with their Q2 2026 guidance.
Right, because going into that, the street was, they were terrified.
Yeah, projecting like a 7 to 13% drop, I think.
Correct. But MediaTek came out and guided for a much softer 0 to 6% drop. They proved they weren't just blindly stuffing the channel with inventory.
They actually had visibility.
Right, and that stability leads to data point three, the EPS upgrade.
The earnings per share.
Yeah, BOFA have lifted MediaTek's EPS estimates. For 2026, it's NT $64.04. And for 2027, it jumps to NT $129.02.
So basically doubling in a year.
Basically, yeah. What's fascinating here is how MediaTek's non-smartphone business is acting as this massive financial shock absorber.
Right, giving them the breathing room to build out the AI stuff.
Exactly. They don't have to go into massive debt to fund the AI R&D because the legacy business is churning cash.
Okay, so if the legacy business is just holding the line, what actually gets them to that 3,000 TWD target?
The ASICs.
Right. Here's where it gets really interesting. The ASIC-led transformation. Let's talk about the TPU ramp-up.
Yeah, so mass production for TPUs tracks really well, starting mid-Q2 of 2026. Bank of America projects this is going to bring in $1 to $2 billion in revenue for 26.
That's a solid start.
It is, but in 27 it explodes. They're projecting $12 billion.
Wait, 12 billion in 1 year?
Yeah, $12 billion in 27. To put that in perspective, that TPU revenue would account for 41% of MediaTek's operating profit by 2027.
That's almost half their profit from a division that barely existed a couple of years ago.
Right, and the total AI ASIC market is expected to be like $70 to $80 billion. MediaTek is targeting a 10 to 15% share of that.
Okay, but you don't get those numbers selling to small players. Who are they actually building these chips for?
Google is the huge one here. They have a milestone collaboration with Google on their training TPU design.
Okay, that's massive validation.
Huge. And they have a follow-on project with Google scheduled to tape out in late 26 or early 27. Plus, they are already in early-stage talks with a major startup and other hyperscalers for an AI accelerator, ASIC.
And that one ramps up in 2028.
Exactly. They are just stacking the pipeline.
So Google in 26 and 27, new projects in 28. It sounds perfect. But, I mean, no investment thesis is without its storm clouds, right? Let's pivot and lay out the downside risks BOFA highlighted.
Yeah, we have to talk about the legacy anchor.
Right, consumer electronics.
If the end market for consumer smartphones and TVs stays weak, or if inflation keeps up.
People just hold on to their phones longer?
Exactly.
Yeah.
It's a massive drag. And you also have rising competition in the system on chip space. Qualcomm is pushing hard, which could really pressure MediaTek's margins.
Which threatens the cash flow they need for the AI pivot.
Right. And there's an AI-specific risk, too. The bidding process for Meta's inference ASIC could be slower than expected.
So if Meta delays, that's a big chunk of projected revenue just hanging in limbo.
Yeah. This raises an important question. Can they successfully manage the drag of these legacy consumer markets while pouring all these resources into the high-margin but, super competitive AI infrastructure space?
Flawless execution required on both fronts.
Ye-
So what does this all mean for you, the listener? How does BOFO synthesize all this into a 3,000 TWD target?
It comes down to valuation logic. They maintain the buy rating and that high target because they are raising the multiple. They're pricing them at 23x the 2027 estimated PE.
Which is way higher than a standard consumer hardware multiple.
Way higher. If we connect this to the bigger picture, as MediaTek locks in these supply agreements and proves out this ASIC pipeline, the market is basically forced to change how it views them.
They stop being a cyclical hardware company.
Right. They start being valued as an indispensable, predictable AI partner.
That is such a fascinating corporate evolution. And, as we wrap up, I want to leave you with a final thought to mull over.
Okay, let's hear it.
We spend so much time fixating on the flashy software side of AI, right? The chatbots, the language models.
Because that's what we interact with.
Exactly. But is the true wealth actually being built by the companies quietly designing the custom, unglamorous plumbing? Like the custom chips that make it all run?
Defining the physical limits of the software.
Exactly. He who owns the hardware limits owns the future of the software. Just something to think about. Thank you so much for joining us on this deep dive. Please make sure to subscribe to the channel. The next episode will be even more exciting.
Thanks for tuning in, everyone.
This video is for research and analysis purposes only and does not constitute any investment advice.